Hi, this is Grant Abbott speaking, and welcome to another SMSF Strategy Smash Hour with me. I've been very quiet for the last 9 months. A lot's been going on, including writing my book, The Guru's Guide to Self-Managed Super Funds. And of course, as you can see on your screen, I've set up a company. I love SMSF.com. And let's face it, don't we all? Well, welcome to this strategy session. It's 45 minutes, so we're going to be really hot and bothered and going through a lot of stuff. I can't believe there's over 900 pages of legislation, guidelines, rulings, explanatory memorandum produced by the Tax Office, Treasury and also the government. It's virtually impossible to get on top of, but I'm going to give it my best shot, and more importantly, we're going to get into some really hardcore strategies. Now, a bit of housekeeping. This is the internet that we're working with, so from my end and also your end. So if things start to get a bit scratchy, if you can't hear, check your computer audio is on. But more importantly, if they're getting a bit scratchy, it may well be your internet connection. You may not have enough download speed. However, do not fear, because we are recording this session and it'll be sent to you tomorrow morning with a number of other bonus materials. If you've got any questions, put them on the chat forum you'll see here online. But look, I can't guarantee that I'm going to be able to get to it, mainly because I'm really running short of time. This is really a 2-hour session, and you'll see on the 19th of May in Melbourne, I'll be having my first and probably only face-to-face session around all of these changes this year. That is both live and streamed. If you can get along to it, we've got some really great pricing I'll talk about later on in this session, but if you can get face-to-face, make sure you do. It's an advanced session. We'll be going into the legislation and going in all the ins and outs of the strategies I found. If you can't make it on the day, if you're interstate and you don't want to make all the travel arrangements, then it will be streamed live at the session. The beauty about being streamed live is that your whole office can see it. And of course, if you've got the live or stream session, it will also be recorded and you've got access to that at a later stage. As I said before, there's some pretty special pricing still on offer. $247 for the face-to-face and only $197 for streaming. Anyway, welcome to the new world of SMSFs. So first up, where have I been? In July 2016, I sold out of Now Infinity, and in particular the documentation space and their corporate messenger. However, I've been able to then go back to the love of my life, which is SMSFs, hence I love SMSF.com. In that meantime, I've been involved in a number of projects. One of them I thought would take me 2 weeks to write, given the fact that I've written 4 books on self-managed super funds through CCH, which are still available for retail at $120 if you'd like to get those. But let me tell you, here's the deal, they're well and truly out of date. Well, I thought this book would take me a week to write. Anyway, I'm down to the final stages of it at this present point in time, awaiting the budget, and then it will be released on the 19th of May at our SMSF Advanced SMSF Specialist Strategy Session in Melbourne and streamed live. But anyway, other projects, I've been involved in one that really has had a big impact on me, and you'll hear more about that later on in the year. It's called Business Bellies. All of us have grown a little bit bigger and broader around the girth as we get older, and I found out it's a lot of it is, well, not a lot of it, it's all to do with stress. I thought it was diet, and I thought it was also my exercise, but essentially stress. But I'll come out and talk about that later on this year. Now, in terms of self-managed super funds, look, sorry to tell you, but in the July 2015 strategy day, I called the height of SMSFs. I said, with borrowing, no RBLs, contribution limits still not too bad, that really we were at the height. This was as good as it was going to get. Little did I know, 11 months later, Scott Morrison would get up and smash the daylights out of self-managed superannuation funds, put in ostensibly a $1.6 million transfer balance cap, which is just like a reasonable benefit limit, and really start to eke out and weasel away at all the ins and outs of self-managed super funds. So much so that even last week they released a guideline draft legislation, which is so scary, that brings to account and as part of the total superannuation balance, which I'll look at very shortly, brings to account the outstanding liability balance on any LRBA into account for total superannuation balances. So we're going to be looking at that. I'll be looking at the legislation around that just quickly to show you how it all fits in. It's taken me more than 6 months to get on top of these laws. As I said, there's around about 900 pages, and the implementation side of things is absolutely scary. The worst is that we've got to put in a lot of things before 30th of June 2017, but my feeling is the Commissioner's computers aren't going to get up to speed in time, so it's really going to be probably around about 6 months before we start to get all the lines drawn. In theory, though, everything should be done by 30 June 2017 for those people who are over the $1.6 million cap. Now, here's a couple of things. The two key strategies you're going to take away with this is segregation and reserves. Segregation and reserves are your keys for the future. I'm also going to give a lot of strategies for what to do now, but that's coming down a little bit later on. Hard thing, timing, we're weeks out from 30 June, so we need to put in place. I've got a great little case study which has been sent to me, which we'll have a look at very shortly. And in fact, it's such a good case study and it's really focused on the death of someone in April 2017, which means it's really in operation right at this present point in time. Unfortunately for us, many of our clients aren't going to rush to 30 June 2017 because they do not know what's going on. And unfortunately, the next 6 to 12 months will unfold exactly what's going to go on, particularly for those who are trying to do it themselves. If they're over that cap, they're going to get commutation notices from the Commissioner, which they will take complete disregard of. And then the next step is the Commissioner will now force a commutation on them and, more importantly, get rid of all tax exemptions within the fund for them. Not for the excess, but within all funds. So that's going to be a lot of fun, but more importantly, because our clients are unaware, so they're at that bottom level, they're what we call unconsciously incompetent, means that they've relied on you for such a long time for all this information that now they're not going to pay for advice because it's negative advice. So we're going to have to re-educate, re-challenge them, get their mindset around the benefits of the advice we're selling. But more importantly, we're not too bad. We need to show them exactly what it is going to cost them, not only initially through ongoing tax, more importantly as we go down the track, and the expense of not doing the right thing when it comes round to estate planning. All very exciting things, complete change. I'm pretty excited about it because, let's face it, the last few years have been deadly boring inside self-managed superannuation funds. And the greatest thing we ever got was the TRIS strategy, which, mind you, is still just as important. In fact, even more important now from the 1st of July 2017, because guess what? A TRIS is not a retirement phase superannuation income stream, therefore it's not tested. So TRISs are back on the list and very exciting. Of course, most people have written them off already, but not Grant Abbott, I can tell you. So let's move on. We've gone through 4 waves, or we're now entering the 4th wave of self-managed super funds. The first one, which I was there for right at the very start, and when we've gone through all these waves, the important thing is, of course, every time we've gone through the strategies, we need to make sure we've got execution and success. But the first wave that we went through was between 1994 and 1999. In those days, because there was no borrowing, we'd be able to use a related unit trust to get around the borrowing rules. In fact, some of us even went a bit scurrilous, certainly not me, but go and have a look at Holloway's case, where Holloway, the accountant, ended up setting up unit trusts for his clients, so they put contributions into a super fund, invested in a unit trust, and then lent it back to the member's business itself. So again, trying to subjugate the in-house assets test. The federal court was having none of this and found Holloway, the accountant, himself guilty. Very important to take that into account, because it means all of us operating in this space can get attacked personally from a liability perspective for any problems we may face under the SIS Act. But the first wave, it was all gung-ho. We had RBLs giving us a bit of a break, but because there was no real strong in-house assets test at that stage, except obviously loan backs to the business, we had a scenario whereby we could put in abalone licenses, computers were leased back, furniture and fit out, even saw bull semen of everything in there. And then in May 1998, we had the Treasurer of the day came in and smashed it and effectively made related party unit trusts all now caught up within the RBL rules. They had transitional rules that went for 10 years, but the main thing at that stage was the tax office taking over self-managed superannuation funds. Albeit by May 1998, there was only around about $43 to $48 billion sitting inside SMSF, so the industry and retail funds treated them as a bit of a joke, really, which, I was out there pushing hard. I still saw the great opportunity that was there in SMSFs, and there was for those people who got at an early stage. Second wave, ADO takes over, and essentially by that stage, everyone's balances have started to increase. We also had a scenario where we could make contributions which were 10 times age-based limits. The way it worked is that effectively if you had a business and you had a number of employees, you could make contributions on behalf of those employees. And of course there was SGC, but anything over and above that, effectively you could claim as a tax deduction. So you might have 10 employees, the age-based limit maximum might be, say, $300,000. You could pay $35,000 under SGC for 9 of them, and the remaining $265,000 would go into your account as a business owner. And again, we try to smash contributions as much as we could. However, everyone had their own RBLs. And in those, we used to do RBL compression strategies, being lifetime non-commutables or lifetime complying pensions. But RBLs were pretty small in those days, so not everyone put money into SMSFs or super. It was really still a pretty backward sort of thing. But then, of course, 2007 came along and Simpler Super was introduced by Peter Costello. At that time, the big thing for me was RBLs dropped off, and of course the gates started to open. And because there was no tax on super coming out after age 60, we still had tax exemption on pensions. Everyone just piled as much money as they could into super. And of course, the contribution rules really started to slow things down. We had concessional contributions caps and also non-concessional contributions caps. Now, of course, that suddenly saw that a lot of money went in, even where the caps were effectively someone over the caps. They would use then the borrowings or related party borrowings in order to get more base amount in there, to which leverage of assets sitting inside the fund, where growth could now come in a pension stage and be tax-free and accessed over age 60 tax-free. So now we've got funds in there where it's not untoward for a lot of your clients to have funds of 2, 3, 5. Some have got 10. In fact, I've seen some up around the 20, 30. In fact, there are known cases of people with a $100 million funds. So the RBL rules are out, but now we've got the general transfer balance limits we have to take into account, which was the change that occurred in May 2016 that applies from 2017. So that's the fourth wave, and who knows where that will go. The fourth wave for me is now the government tinkering around at the edges or really going hard at it in order to extract more revenue out of superannuation. Even after these changes, we're still in a negative situation in terms of tax flows into the Treasury coffers from self-managed super funds. So again, let me tell you that because of imputation credits, I'm going to talk about eligible startup innovation companies later on where you get offsets. Because of these offsets, these imputation credits being able to negatively gear inside the funds, we're in a scenario whereby tax is more often than not refunded to self-managed super funds than actually paid to the Australian Taxation Office. So the net effect is money flows from Treasury to self-managed super funds rather than SMSFs to Treasury, when a net impact on the budget, and that can only go for so long. We're at the thin edge of the wedge, and this is what Morrison's changes have gone. So expect a lot of changes, but we can only deal with what we've got in front of us, the 900 pages of stuff that we have to go through, look at it line by line, extract out what it means, how it's to be implemented, and more importantly, how we can maximise the strategies for our clients. Now, more importantly from that one, it's great to have all these strategies, and we're going to be talking about a few here, and we're going to talk about a lot on the day, on the 19th of May. Today I'm talking about strategy. On the 19th of May, I'm talking about execution. Success of a strategy does not arise unless you have execution. For example, many of you are probably in a downward situation in terms of pensions. If you have not got an auto-reversionary pension, a term I coined in 2002, one that immediately kicks into the next person on it, then effectively it means you've just got an ordinary reversionary pension. The Commission's got rulings on that and has now come into play under these new rules, such that we should all be aware that a reversionary pension, whether it springs up or it's an auto-reversionary, is to be counted in as the recipient's transfer balance. But the beauty about it is, if we are an auto-reversionary, we've got 12 months to adjust our levels, whereas if we haven't, we're pretty well stuffed. Auto-reversionary, absolute must. Make sure your deed's got it. If your deed hasn't got it, if your documentation doesn't have it, then your execution is out and there's not going to be any success. And we're going to come a lot of traps and pitfalls later on. But we'll be looking at a lot of the how-tos on the 19th of May. So let's see what we've got. First off, if you're playing in this game, I'm presuming if you're on this session, you're either a trustee, and if you are a trustee, sorry about jumping forward there. If you're a trustee, I'm going to cover a lot of strategies here, but more importantly, it's important for you to get my book, The Guru's Guide to Self-Managed Superannuation Funds. As I said before, my 4 previous books cost $120. This book will be free to you, particularly if you are at the launch on the 19th of May. So that book in itself has got a lot of strategies of what to do at the 1st or coming up to the 1st of July 2017. For those of you who are accountants, administrators or advisors, in order to provide advice to your clients as to whether to take any excess monies from the fund, and when I mean excess over the transfer balance limit for a retirement phase superannuation income stream, either to take it out, that is withdraw the money from the system, or roll it back. In order to do that, you don't need to have a product disclosure statement. There's a specific exemption in the regulations, the corporation's regulations for that. However, if you do advise on that, you need to be licensed. A rollback or a transfer out as a lump sum by way of a commutation is treated as a financial product. You see, setting up a self-managed super fund is not a financial product. Contributing to a fund is a financial product. Becoming a member of a fund is a financial product. Making investments inside the fund is a financial product. Taking an income stream is a financial product. Commuting the income stream is a financial product. Rolling back in order to adjust and meet the $1.6 million personal transfer balance slip is a financial product. If it's a financial product, you need to be licensed, and you must also provide a statement of advice for the client. And that's what I said right at the start. If you're going to give this advice to the client, you need to tell them about the detrimental side, the denigration of their account balance because of taxation, in order to tell them about the need to have a statement of advice under the Corporations Act, and more importantly, that is going to cost them. Now, importantly, if you're a specialist SMSF advisor like myself, and more than 1,000 people have gone through my specialist SMSF advisor course, then you will have been through RG146, or more importantly, you may well be a specialist advisor under the SMSF Association, which means it's a requirement to read, understand and apply the law. So let me say that again. If you're a specialist SMSF advisor, you must need to read, understand and apply the law. And how do I know that? Well, I wrote those standards way back in 2004 for RG146 and 2006 or thereabouts for the SMSF Association, which was known as the SMSF Professionals Association of Australia at that time. I helped to read and write those laws. So you must need to read, understand and apply the law. Now, the big deal for us is, as I've said before, we've got more than 900 pages of explanatory memorandum. We've actually got amendments to the Income Tax Assessment Act and the regulations, and we've even got amendments to those amendments. Plus, we've got ATO guidelines, legislative compliance guidelines, that even then give the Commission's interpretation of the amendments to the amendments. And quite often, believe it or not, those interpretations don't match up with the amendment to the amendment. So we've got this extremely, and I don't know, for those of you who've been through the legislation, and remember, if you're a specialist advisor, you're supposed to have gone through all of that. For those of you who've gone through it, I find myself the last 6 months poring over this, and really it has been so perplexing trying to find out which bit fits in where, how it fits up, and more importantly, whether it's been amended and how does the Commissioner then interpret it. In fact, the last week I've been spending countless hours going through everything again to really delve into strategies. Until you get within the law, the Commissioner's guidelines, you don't know what the strategies are. We've got to go deep and then we have to go up in order to build those strategies. So it's taken me 6 months, and of course, I'm writing my last couple of chapters of the book which talk about taking benefits out. Of course, they have taken the longest time ever. Did I say before, I'm not sure, with my book, The Guru's Guide to Self-Managed Super Funds, I'm writing an advanced version for SMSF specialist advisors, which will come out post to July 2017, and will really mark a line in the sand for what is going on down the track. The beautiful thing about it, and this is the big but, there is so much work in here for decades to come, and really this is only the thin edge of the wedge. As I said, we're in a negative budgetary impact in that SMSFs suck on the budget teat rather than giving money back. That ain't going to last that long. So expect changes. I don't think there's going to be changes in this budget, but can I predict that? Not sure. Doesn't matter. We're going to put all this to play on the 19th of May. Now here is an interesting scenario. I want to have a look at this wonderful question from Kerry Mitchell, who's a financial advisor and has had to put her mind to all of these rules, mainly because her client has died, and so she has no choice but to apply the laws as she has read, understand, and apply them to this client's situation. So let's have a look at this. Unfortunately, Kerry, I apologise profusely, but I'm not going to be able to go into any detail. I've got 3 or 4 strategies I'm going to roll out on the 19th of May around this. In fact, I'm going to use this case study on the 19th of May because it brings in a whole lot of issues. I'm going to extrapolate on it in relation to a couple of the issues, but it's very exciting. And Kerry, I would give you a good 8 out of 10 out of this one. The client's done really well having you as an advisor, but how much are you going to charge? Because there's a lot in there. And as I said before, I think there's a lot of changes I would make, and I'm sure there's a lot of specialist advisors who I'll be sending this out as part of the bonus materials to make sure how they would look at this. So let's have a look at this wonderful question from Kerry Mitchell. So this is a 4th wave question, and really I've got up there, are you ready? And that is absolutely crucial because as we go down the track, and Kerry's been faced with it, in fact, it smashed her right on the forehead because the client's died. She has to do something around it, has to do something quickly. As I said before, the danger we've got is our clients are unconsciously incompetent, except the trustees who are on this call. You guys, congratulations, hats off, thumbs up. You've done a great job because you are now concerned and worried about what might be coming down the track. And if I was, I would be too. I can tell you, just coming up to age 60 myself, I can't believe it. All of this stuff is hitting me in the face, and I'm having to work, rework, and rebuild my SMSF. In fact, not one, but my 2 SMSFs as we speak. So let's go and have a look at the background to this case. We've got a self-managed super fund. So the first and main thing that I look at, Kerry, you haven't even noticed it in there, is you need to get the deed out. You need to get all your documentation out to see exactly what you've got in front of you. My thinking is that it's probably going to need to be upgraded. You've got a corporate trustee, upgrade that as well to make it a special purpose corporate trustee. Again, I've had a hand in a number of deeds, now Infinity, etc. So have a look around, make sure you do your good analysis of the deeds and get the best, and also the corporate trustee. Anyone who's using a shelf company for a corporate trustee, you will go down in flames over a period of time. Look at Holloway's case in 1997. Look at what can happen to your professional reputation if the ATO or your client takes you to court. Anyway, we've got a husband who's now age 65, April 2017. So as we speak, they're now 65 years of age. All their benefits are, of course, unrestricted, non-preserved. His wife has died in March 2017, just introduced a new member. So in essence, if this was another fund, we would have our legal personal representative being automatically appointed as a director, if that's possible. Now, there's a couple of tweaks you need to find in a special purpose corporate trustee to do that. But in this instance, because the husband is still alive, we're okay. New member of the son, I would probably at this stage not introduce the son as the new member until we get all of our estate planning down pat. Otherwise, he's going to be involved in the process, and it just doesn't seem to make sense. Because while we've got a corporate trustee, we can have a single member corporate trustee for the next 6 months. So just sit down, get it done, and then get the son in a little bit later on, probably prior to the 1st of July, because we want to make sure that if there's a non-concessional component, we can use that 540 cap. Anyway, the assets at the time of the death within the fund, it's unsegregated. So we've got two members in there, 1.7 million. So we've effectively got around about $880,000 each. One would now be sitting inside one of the members' accounts. We haven't got any pensions at this stage. I'm assuming they're all accumulation. They're both around about 880 at this stage. All the contributions of the fund are non-concessional. One thing you need to do, Kerry, for me, and send it to me for the purpose of the 19th of May, is how much is the taxable component on those contributions. Sure, we've got non-concessional, but there's been earnings on those. All earnings, listen to this, all earnings on accumulation are always taxable component. Whereas if our non-concessional goes in solely, if we set up a brand new fund, put non-concessional into a self-managed superannuation fund, started a pension from that, all earnings would be tax-free component, which makes a big difference to our beneficiaries. And particularly the son here, who's obviously an adult dependent, makes a big difference to whether they are receiving taxable component or tax-free. If I was the son, I'd be putting my hand up for tax-free. Taxable component is a bit of a nightmare, which comes around to a whole estate planning session, which I'll be looking at for 2 hours on the 19th of May. It's a brand new world that we're looking at. Anyway, we've got a defined benefit pension, just to muddy the waters, that's already in existence. That is $22,000, but the wife has died, so it's a reversionary, so it carries on in the husband's name. And the lump sum equivalent, or an amount that is to be tested under the pension transfer balance limits, is $241,000, which is effectively 16 times. Now, I'm going to have to go through prior to that to see if there's any other loopholes or, ways to adjust quite effectively that for what we call a defined benefit fund. But at the moment, we're stuck with that. I'm not sure generally if it is a com super, we can't just commute it to a lump sum, which would be ideal. We have to keep on with the pension. So that's locked and loaded into the husband's personal transfer account balance. So there's not much we can do about that one. With the fund assets, he's got around about another $860,000, but if he puts all of the fund's assets, you can see here Kerry's done the right thing, puts all the fund's assets plus the $241,000, we're going to find we're over $400,000 in excess, which means, guess what? We have to commute, and that means we either take the $413 out or we roll it back to accumulation. So we take it out or we roll it back to accumulation. So what we've got there is, she's done a preliminary calcs and shown excess of 413 allocated to the husband's rollover cap of 1.6. Is my thinking correct? So again, as we said, roll it back or take it out. I'm going to come in a little bit later on and suggest that the new theme for all of us as specialists, that we're not specialist SMSF advisors now, particularly for the new generation coming through. We are family wealth advisors, not family officers. That is such a boring term. We are now family wealth advisors. Leave the family officers to the Myers, the Bally's down in Melbourne. The guys have got really big sums. That's their purview. Someone with $2 or $3 million, that ain't no family office. What we've got is a family wealth advisor. Anyway, let's go down. She's recommendations. I'm going to tweak these on the 19th of May. But look, you've done a very good job, Kerry, and well done. Hats off to you. Nothing like having something right in your face in order to make sure that you're on top of it. But we've got the husband commencing a death benefit income stream. So that's with the spouse's benefit of $886. Plus we've also got the 413. She's taken it off and she's basically looked at a different point of view. Roll back his own account-based pension balance of 413. Now there are benefits in that. I'd like to see the taxable component and also the tax-free component that's basically sitting in there at this present point in time. In particular, if we go down, the fund's going to elect to adopt the proportionate method because we're over $1.6 million, as you'll see shortly when I deep dive into the legislation, that in order, once we've got someone in there who's got 1.6 million, in fact, if we've got anyone in our family who's 1.6 million, they're what we call a pariah or an excess member. An excess member means whatever self-managed super fund they touch effectively is poisoned in that it can only use the proportional method. So she's doing the right thing here, using the proportional method basically for CGT relief, but she hasn't got any other choice. So we can cash out from the husband's accumulation phase to the son. Not a bad strategy. In fact, what we could do if we wanted to, take out more than 413, get down below the $1.6 million, and then we can use segregation still because his balance is less than that. So we might want to go through and have a look at that strategy as well and see the benefits of running segregated versus proportional. Because if we're running segregated, then what we can do is effectively be in a position of putting some caps on there. But we'll have a look at that. So if we transfer and pull it all out, just leave the pension there for the husband, and then effectively what we've got is the balance going to the son. Now the son making non-concessional contribution prior to 30 June 2017, that's when we do introduce the son as a member and also a director of the corporate trustee. So we're going to have a look at that. Life insurance, there's a lot of estate planning that needs still to be completed in relation to that. As I said, the son would be more appreciative of having tax-free benefits coming than taxable benefits. So this is a really good 7 or 8, Kerry, done on a pretty quick, short period of time. But I'm going to have a look at this and start to pull it apart. For those that are there on the 19th of May, we're going to have a lot of fun with this one because this is the fourth wave questions that you're going to get day in and also day out. Now, mind you, a lot of your clients aren't going to come and effectively set themselves up with this strategy from the outgoing. It's going to be more corrective surgery, which means you're going to have to work out how much you charge. In fact, I'd love to know, Kerry, if you're turning up on the day, how much you would charge for this particular strategy. Anyway, let's get back into the meat and the guts of our strategy session today. So let's start at the start, and for me, the key, it's always hard to know where to start, mainly because when we're looking at excess members, we're going to be looking at pension transfer balances, we're going to be looking at non-contributions. So where the government's made all these changes or Treasury's made all these changes, where do we really start? And of course, the place that I start is one of the keys that has the most effect. And for us, we need to look at the term of what is a total superannuation balance. More importantly, as I said before, if you've read the screen, it's important that you get your client's deed updated, upgraded to make sure it fits these new terms. If it hasn't got a retirement phase superannuation income interest in it, then it is not a modern deed. So let's just turn now quickly to the superannuation guidelines. I find it's pretty good to have a look at what the Commissioner says around subsection 290-234A around what is a total superannuation balance. As you can see up on the screen, a total superannuation balance at a particular time, this is from his ruling, LCG 2017/12, it includes the accumulation phase value of your superannuation interest and not in the retirement phase. So that's essentially looking at not only SMSF but all funds, working out what your accumulation phase value is. Now, if we've got an industry or retail fund, it's pretty easy because they mark to market, they do unitisation. You might be off maybe a week at the most. Perhaps industry funds maybe like 2 or 3 weeks after that. But inside a self-managed super fund, we've got a different ballgame. You see, you only have to mark to market your assets as at the 30th of June each year. And that will then carry you through until the following 30th of June, whereby the trustee at any point in time during that year can rely on the past assets or the past asset valuation. In terms of property, some people don't value property, or they value property once every 3 years. And particularly when we've had a market like last year, where property at the moment is extremely volatile, the determination of the accumulation side of the fund, whether we're $1 million or 1.2, I would dare say that is never exactly going to be what we record. And so as we go down the track, particularly now that a lot of the new legislation, the implementation is completed by the Commissioner, we fill in the forms, but the Commissioner now assesses that when we fill in the form that the balance is $1.6 million, is it actually 1.6? It's more often than not, it's going to be more than 1.6 if we're looking at a rising market. So can the Commissioner come back and then start to challenge the valuations? I would dare say over the next 15 to 20 years, much the same as we saw all the flurry around excess non-concessional and all of that stuff, we're going to see a lot of work done around valuations. So expect to see a lot of valuation rulings coming up. If the client's got cash, you're going to be A-OK. If you've got listed shares, you're generally going to be A-OK. But otherwise from that, you're going to be in not real strife. You're just going to have to make sure that you've got the best valuation possible. And as I said before, strategy, execution. The execution is get a valuation on the time that you're determining your total super balance. And we're going to look at that very shortly. If you've got a superannuation income stream, then you would have already tested against your personal transfer balance limit. Now that might have been, as we go down the track, it might have been last year, the year before, and I'm looking at maybe 2020 or 2021. What we need to do to find out what our addition to our total super balance is, we need to back out what we had before, do a few adjustments, for example, with structured settlements, which primarily come from personal injury cases, and then back those out and effectively go back and work out what our transfer balance is. That is, what is actually sitting in our retirement phase superannuation interest, income stream interest at that point in time. And that's going to include part of our total super balance. And of course, we've also got our rollover super benefit is to be included. But really, for most of us, that's not going to be a big issue unless we're moving from a retail or an industry fund into a self-managed super fund directly to set up a pension, because it might be sitting in abeyance at that time. But it's very unlikely. Otherwise, people could sort of hide things in the rollover balance in order to set up the pension. Importantly from that one, I just want to do a bit of an aside. I'm going to come back a little bit later on. A couple of weeks ago, they released some draft legislation which also includes a proportion, and again, I don't have time to go into it in any great detail here today, but I certainly will on the day on the 19th of May, and we're going to have a look at the legislation itself, but will include as part of the accumulation phase value generally, if it is sitting inside a superannuation fund, it will include as part of the balance, the outstanding balance, the liability of that fund. So for example, if I go back to Kerry's wonderful case there, we've got the son there, and the son uses the $400,000. Remember the non-concessional contribution he's got there, and then he ups it and gets a $600,000 loan, which is well within the limits then effectively what we've got there is a $1 million. If he's got $600,000, $1 million asset, the entire value of that asset is included as part of his accumulation phase value, notwithstanding he's got a $600,000 liability. How that works, no idea. Why is it the case? No idea either. Now, that would only be the case, and again, now things get really murky, if he has got a segregated investment strategy. You see, here's the deal I said right at the start, segregation is now going to come into play. Because if he hasn't got a segregated investment strategy, it fits into the pooled strategy there for both himself and also his father, who's got the $1.6 million pension balance, then effectively it becomes extremely nasty. Repayments of principal and interest actually add, not post, but add to his transfer balance limit as though there are additions. So he's going to blow himself up pretty quickly. How that works in practice is pretty ugly when it comes around to implementation, but I'll be going through that exact strategy and how to get around it on the 19th of May. One of them, of course, is to utilise separate investment strategies or segregating. Of course, it doesn't necessarily work if we're already over the $1.6 million, as we're going to see very shortly, because segregation doesn't apply once we've hit a total super balance of over 1.6, nor do the following. So again, this guideline from the Commissioner talks about the importance of determining the $1.6 million. First off, for unused concessional contributions cap. So if your total super balance is not 1.6, but it's actually $500,000, then you, at the start of the financial year, you may be able to increase your concessional contributions cap. So that's if it's less. Otherwise, you can't increase it. So what we've got is unused concessional contributions for one or more of the previous 5 years you can claim, not if you're in excess of $500,000 of your total super balance. So that may come into play where we've got TRIS, so be very careful around that one. Non-concessional caps and also the bring forward, if you've already hit the 1.6 million, forget about making non-concessionals, and particularly there's no bring forward. If you're less than 1.4, you hit 1.4, you can still do the bring forward rule, but once you're between 1.4 and 1.6, there's transitional rules to apply. And remember, it's your total super balance, what's sitting in your pension, your accumulation, and also any of those rollovers that are in transfer phase. Government co-contribution, same sort of thing with your if you've already hit your general transfer balance, you can't do it. And the same thing for spouse contributions. If either you or the spouse have hit that 1.6, you're in trouble. The big one that I like to have a look at is this total super balance for self-managed super funds. This is where we call the excess member. That's someone who's over the 1.6 million, the pariah. So let's just go through and see what the Commissioner says. So it says, your total super balance is also relevant to self-managed super funds and complying funds with fewer than 5 members. They're small APRA funds for determining their eligibility to use a segregated assets method to determine their exempt current pension income. So please, at this stage, when I talk about segregation later on, I'm talking about segregation for SIS purposes and also enabled under the trust deed. Does our trust deed enable us to write separate investment strategies for members or even part thereof? Now, unfortunately, once we hit the 1.6 million, as you see, you won't be able to use segregation for tax exemption purposes. You'll need to use the proportional method, as Kerry did. In fact, one of the things I'm going to work at is with Perry. Sounds like Perry Mason, to get Kerry's client under the 1.6 to see if there's a benefit there for us. Anyway, if we can't use a segregated, if at a time during the income year there is at least one superannuation interest in the fund that's in retirement. So obviously if you've got retirement phase, you need that anyway, because what's the point of what's the point of getting the tax exemption segregation methodology? So that's a tax methodology as opposed to SIS if we've only got one super interest. Just before the start of the income year, a member of the fund has a total super balance that exceeds 1.6 and they are a retirement phase recipient of a super income stream. The member's total super balance includes a member's super interest in all funds. More importantly, an income stream does not have to be from their SMSF or small APRA fund. It can be from another superannuation income stream provider. So, for example, with a Kerry's client in this instance, the fact they're a reversionary pension member from a ComSuper account would mean that they are caught, even if they don't have a retirement phase income stream inside the current SMSF. And finally, at a time during the income year, this member has a superannuation interest in the fund. So the fact that we've got if we go back to Kerry's situation, they're already in receipt of a ComSuper pension account. They've got a balance inside the fund. It means they've already hit that total super balance. Now, it's not going to impact in this fund if he doesn't have an income stream, but you will not be able to have segregation. The only way we're going to make sure that we are enabled to have segregation from a tax perspective is to drop it down below $1.6 million. Anyway, that's the Commissioner's guidelines on total super balance, and it's certainly a great place to start for us. We've read, in part, because the law is much the same, this virtually comes out of the explanatory memorandum, we've understood it when it applies. Now we have to apply it. We applied it to Kerry's case, and we're going to apply it on a few more instances on the 19th of May, but more importantly, I want to have a look at what happens in the event that we get underneath that $1.6 million, particularly in those cases which are borderline that we've got, for example, with Kerry's case. So what are some of the strategies dealing with a $1.6 million excess member? As I said before, they're the pariah, but essentially, I'm jumping ahead there again. The excess member essentially is now anyone who's over 1.6 million is being tested is, as far as I'm concerned, an excess member. That's when their total super balance, not the amount that's being tested, but their total super balance is over $1.6 million. Because if that's the case, then all those other criteria that we looked at before around non-concessional, around the spouse contributions, co-contributions, segregation, all starts to kick in. So it appears that if we've already got someone who's in excess, there's not much we can do. Well, the first thing is, perhaps in Kerry's case there is, but there's not much we can do. However, I'm going to talk about segregation reserves. Let's have a look at how they got there in the first place. Now, your clients have put in concessional and non-concessional contributions and probably business proceeds in there to have a really good cap balance that's sitting in there. In fact, if you put in non-concessional some business proceeds, you're going to be able to tell because it's going to have a tax-free component. Any concessional goes to taxable component plus growth thereon if it's in the accumulation. Now, earnings on these contributions, whether segregated, most people don't use segregated or proportion, basically get it proportioned not on that segregated investment strategy. Remember, we're not on a tax, we're in the SIS and the trust deed. If they're not allocated directly into that person's account, they get proportioned across all members' accounts, so that the growth thereon has had quite an impact on that fund. We've seen that in another case, Irving versus Dunstan, which has created quite a bit of a furor way back in the 2000s. Not for this case, but what happens where there's proportion versus segregation. Segregation, Irving versus Dunstan, would have been an absolute perfect way to ensure that there was no fights, but they used proportional, which created huge problems. Insurances obviously add to value, probably not the case for many of our clients, and also where we allocate from existing reserves, that also increases balances. So if you've got a client who's got 2 million or 3 million, 4, 5, 6, a lot of the growth there, or the amount over 1.6 million, hasn't been from the contributions or the business proceeds they've put in, it's been from the growth over the last few years. And I feel very sorry for those people who have to make an adjustment from the 30th of June, because at the end of the day it's been growth prior to that, whereas if we have a look from the 1st of July 2017, everyone who starts a pension from there and gets the $1.6 million right, effectively means that their growth is not to be tested. So it's retrospective, but you have to deal with it. As I said, I think a lot of clients are going to have their head in the sand. For accountants, it's very difficult to advise because this is obviously financial product advice. Don't get caught in there because effectively there's a pretty big downside there. But these clients may not do anything. When you lodge the return or the commissioner comes and tests, to the extent they're excess, commissioner is going to give them a commutation notice, and there'll be if they don't work with that commutation notice within 60 days, there's a forced commutation. If they don't meet it within the Commissioner's guidelines, then the whole fund loses its tax exemption. Not for the benefits out, but certainly for the fund itself. If it's not a non-complying, it just loses its tax exemption, which we don't want. So, dealing with the SMSF member now, again, limited time to act. Your clients probably aren't going to understand it because they're unconsciously incompetent. I don't know what it is about my program. It loves to jump ahead. But effectively, we've got to make sure we charge for it because there is obviously a lot of downside here if we make a mistake. Long term, what we want to do is build reserves. Certainly, for those of you, if you haven't done your accounts for the year ending 30 June 2017, you want to make sure your earnings go into reserve. Certainly for 30 June 2017, you want to make sure your earnings go into reserve and start to build pension reserves. I'm going to spend a good hour on the reserves in the 19th of May, showing you how to use it, why it's so important. And the fact is, many of you, if you'd use reserves, wouldn't be in this position as we stand at the moment. But it doesn't matter, we just move on. Segregation is now important than ever, but segregation not from a tax perspective, but segregation from a trustee and also assist perspective, where we, for example, the son in this instance can have their own separate or segregated investment strategy. It's really important for the taxable component for estate planning, really important for maximising income into the pension side where we're going to need to make that payment out. Getting growth on the right side of the fence. You see, if we've got startups and they take off, it's over on the pension side, then effectively we're going to find our growth there rather than on the accumulation side. LRBA issues are fundamental, as I said before. Think of what a nightmare it would be if we do set up an LRBA either side of the fence. And we're going to look at that on the 19th of May. If we're using a proportional method, so we have to, if we're over 1.6 million, we've got no choice, then effectively there's no Part 4A because we're using the worst tax consequences possible and we're not doing anything called asset recycling. So thank you for that one, Commissioner. So now planning for a bigger member. So for example, the young son, as I said, if he did an LRBA, he could be up around $1 million at this present point in time. But if we look at the big member themselves, plan for it. So contributions are limited but doable. So remember, age-based limit way back in 2007 for someone over 50 was $107,000. It's now down at $25,000. So it's non-concessional, which has also been pulled back for us. And the thing about non-concessional, if we go over that, we have to take the money out. So contributions we're going to have a really good look at. Business proceeds over 15 years, provided you're under the CGT cap of around about $1.4 million, you're okay to put those capital proceeds in. They are exempt from non-concessional. Likewise, the CGT exempt. But of course, once you do that, your total super balance goes up. So you need to effectively jump in and set up and clear off your total super balance as soon as it gets to close to your general transfer balance limit. We need to set up that pension ASAP. Of course, we need to be retired. I'm going to be looking at what is retirement under the Act. TRIS doesn't work, preservation age, but once you're age 60, you should be setting up a pension straight away at that time. LRBA draft legislation, talked about that before. Again, it's really put a mocker on a lot of LRBAs. So we're now going to have excess member LRBA funds, which is going to be a nightmare. But anyway, we need to look at that for total super balances. Reserves, a lot of people said don't use reserves. Well, I can tell you all the people, the SMSF reserve experts that I know, keep on getting rewarded. Their clients do time and time and time again. So just get on top of it. Come and look on the 19th of May. Listen to it for now. If you like it, use it. If you don't, then don't use it. You've now got modern administration programs like Class Super, BGL 360, which now allow you to use a multitude of reserve accounts. So they're sitting there. Use them. Don't lose them. So what do I like? I love family super funds with floating reserves, real multi-generational funds. Absolutely crucial. There I go, jumping again. So family super funds, love that. embrace the accumulation side. Remember, it's still concessionally taxed at 15% of taxable income, and you get a 1/3 CGT discount. It's not a bad thing. So focus. If you're investing in shares and you're getting franked dividends, you're still in a pretty good position. The Commissioner is still, the Treasury is still going to pay you at the end of the day if you've got no other income, still going to be paying you a refund. If they stop refunding, imputation credits, a whole different ballgame. But while they're there, embrace your accumulation side. It means smart, tax-effective investment. And at this point in time, there's none better than our early stage innovation companies, where we get a 20% tax offset and a 10-year capital gains tax-free. Certainly makes the accumulation side look pretty exciting. So that's absolutely crucial. And also for those who want to work into a pooled fund where it's a 10% tax offset, you're looking at early stage venture capital limited partnerships, which are also pretty good. And of course, overlaid on that, tax effective investment, negative gearing, imputation credits, tax deductions for insurance premiums, and also your charge out bills or your WIP or your accounts that you pay or that you get them to pay is also important. Plus, as I said before, forget family offices. Family Wealth Advisor is the new go, and in essence, make sure that you have the skills and the ability to effectively provide investment advice for that. Let's face it, I love SMSFs, even name a new company after that. As I said, I was there right from 1994, day one, talking them up. But we are facing the thin edge of the wedge. As I said, there's going to be a lot of changes going down the track as the government tries to extract more and more out of our self-managed super funds. You can see how tightly they are targeted, and it'll be the case. When there's 10, 20, $30 million funds, it's always going to be the case that they're going to start to attack and make sure that these people want to pay their fair share. So what I would be saying is we need to bring into play the family trust, particularly for people in retirement phase. So at this point in time, by 30 June, there's benefits of rolling back to the accumulation, but don't forget the utilisation of family trust as an investment vehicle. They last for 80 years, easy way to pass on estate planning, as opposed to crystallisation for estate planning from a self-managed superannuation fund. In fact, can be very expensive if you've got taxable component and capital gains. When we crystallise an asset for the purpose of paying out a death benefit on the accumulation side, it can be extremely expensive compared to a family trust. So for me, the Family Wealth Advisor will have as tools the family trust and also the family super fund, alongside the family SMSF while they're working. In retirement, family trust, family SMSF, and then on death, they'll have the family trust, family SMSF, and also the perfect tax and asset protection triumvirate being the testamentary trust on the lot as well. So there's a lot to get around, but if we can do it, we really start to put ourselves in a much better light compared to other advisors out there. Again, the key is to read, understand, and apply the law. So back to the fourth wave as we move into closing off. There's limits that can be used to acquire an investment phase income stream. Oh, there you go. There's me jumping ahead. Make sure you come along. May the 19th. But includes deferred income streams, but not for SMSFs or deferred income streams. So I thought it would have been great. As I said, the contribution rules are pretty easy to determine, except if they're in specie contributions. But there's going to be a lot of hoo-ha around valuations. So my feeling is make sure from an evidentiary point of view, when you are setting up a pension, and it is a requirement under the pension rules that the Commissioner has released, to make sure you get a valuation of all your assets at that time. Same way with total super balances, make sure you get valuations at all time. But once you're in there, you've hit your pension transfer balance, then effectively anything on the other side, on your pension side, any growth thereon effectively is not tested again. And I think that's a pretty good thing. Unless, of course, it's an LRBA, so be scared about that one. But more importantly, the tax-free taxable component that's struck up once we set that pension into play will then fold out, and any growth will be cut up to that tax-free taxable component proportion which can be used then for our adult dependents when they receive a lump sum, as opposed to, if it's back on our accumulation side, any growth thereon effectively is taxable component, which our dependents don't like. If that's the only way to play, then I believe a family trust is a better value. Now, of course, TRIS, that is not part of the tax exemption. Again, if we start to blend that with an ESIC, which I think is a great opportunity, TRISs are still well and truly back in the play, because a TRIS allows us to access our superannuation even while we're working, but more importantly, a TRIS is not counted for a personal transfer pension balance. So, as I said before, make sure you come along on the 19th May. Just to wind up, tomorrow we'll be sending you a recording of this session. I've run out of time. I'd love to spend more time on estate planning. So anyway, let's just finalise here. I've run out of time. Haven't even got into in-depth estate planning, reserve planning, but I will on the 19th of May. We're going to be going through a lot of the laws. I'm going to show you, to build up your confidence, how the next 5 to 10 years are going to play out. So if they do make any changes, we're going to be all over it. Make sure you come in person. There's still a special offer until the 10th of May. So that is post-budget. In fact, I think it's the 10th of May, whereby you can use the lower pricing of $247 face-to-face. If you can get face-to-face, it's the best way of learning. As I said, I've had 1,000 people go through my course. You know how I read, understand and apply the law. We've got a lot of case studies that come through. If you've got case studies, please feel free to send them through. I'll make sure I get to them on the day. Importantly, if you want your whole staff to get trained, go on the streaming, which is $197. Again, make sure you book that in before the 10th. I'd love to see you there. Go to ilovesmsf.com, put your name down for the book. As I said, there's the advisor book will be coming out just after July. But at this point in time, I'll be releasing on the 19th of May, The Guru's Guide to Self-Managed Super Funds, Turbocharging and Growing Your Super Now, which is pretty important. If you want to get a printed copy of that, it's only $20, which simply pays for printing, postage and also handling. Now, also don't forget to be a fan of our Facebook page. Each and every day I have a daily strategy session or a Facebook live session going out at that time. Anyway, we've gone through a lot of stuff. It's Grant Abbott. Looking forward to catching you on the 19th of May, or making sure that you listen to my words and my strategies in the Guru's Guide to Self-Managed Super Funds. It's Grant Abbott, signing off.